Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
And welcome to Bloomberg Deals. We have a great show for you today, and we start with JPMorgan CEO Jamie Dimon, who says that he's on hunt for his next big deal. He spoke earlier at the Bernstein Strategic Decisions Conference.
I do think there might be, in the next couple of years, a chance to put $10 or $20 billion to work buying something. And when we do that, we'll explain to you why we think it's a great purchase. But also, I think, just if you hear me, I think asset prices are high, including JPMorgan stock. So, I'm not that fond of buying stock at these prices or companies, and we're quite patient with capital.
And Herman Chan from Bloomberg Intelligence joins us now on this. Herman, JPMorgan's already a behemoth. What else do they need to add on at this point?
Right. So they are definitely a behemoth in the U.S. There are probably certain pockets of businesses that they could afford to bulk up on. And this has been discussed in the past. So I would characterize three possibilities in terms of what Jamie just talked about in his comments at the conference today. Number one, probably something internationally. So they have fledgling consumer operations in the UK and Germany, so they could afford to bulk up there. The second is probably payments, where we have new payment rails, new technology, new competitors coming in trying to usurp. I think JPMorgan has an opportunity to bulk up their payments business. And third is probably on the asset management and wealth side, where they're already very strong, but could be stronger as well.
He was talking about this idea. We can sit on the money we have on the cash pile. We don't have to deploy right away. But also share prices, including JPMorgan, are high. In order to get some of these done, does there need to be some softness in the market? Is that something that they would wait for? Do they need to essentially wait for another SVB to really pounce in and do some transformational deals?
Right. Well, their stock's already trading at 2.7 times tangible, which is way above any of their competitors. So the market's affording them an opportunity to do a deal today. It's really about their patience and what they think is strategic and really worthwhile from a risk-reward standpoint. So that being said, if there is another regional banking crisis and First Republic comes along, I'm sure they'll be happy to do something like that as well.
That would not surprise. Not the crisis wouldn't surprise me, but JPMorgan taking advantage of a crisis would not be surprising. Thank you very much. That's Herman Chan from our Bloomberg Intelligence team. Now, another deal we're following today, the resolution of a potential proxy fight. Lululemon has resolved an ongoing dispute with founder Chip Wilson by appointing 3 new members of the company's board. Wilson has been campaigning, buying Lulu shares for months, trying to get this done. Bloomberg's Lilly Meyer joins us now for San Francisco. So the proxy fight avoided Lilly, but this is a man that Lululemon had basically been disparaging, saying he doesn't speak for us. His ideas are outdated, and now they have some sort of agreement?
Yeah, so there's been a ton of back and forth over the last few months. Chip has been pushing for change. Lulu has been pushing back. And so finally, just less than a month before the annual meeting is scheduled, they've reached an agreement.
And what is that agreement? It seems that Chip Wilson gets a lot out of it. He gets board members. What does Lulu get? Just basically shutting Chip Wilson up for the next year and some change?
Yeah, so, Chip is appointing 2 board members that were on his slate for nominees. They're going to pick a 3rd director in October. And then, Lulu, Chip has agreed to an 18-month non-disparagement. So the constant letters and criticism of the brand, will stop for the next 18 months.
Lilly, thank you very much for joining us. That is Bloomberg's Lilly Meyer. Elsewhere in deal news, pharma giant Eli Lilly announced that it's buying 3 clinical stage vaccine developers as for as much as $3.8 billion. It's part of a larger shopping spree we've seen from Eli Lilly, which has announced more than $20 billion of acquisitions this year. Michelle Davis covering healthcare for us and deals and joins us now. Michelle, why venture into this area of vaccines, of infectious diseases?
So this is really a re-entry for Lilly into infectious disease, which it hasn't been in for decades. What they said is they really want to get to the root of diseases rather than treating the symptoms, especially as we have a lot of infections that are developing antimicrobial resistant. And so the vaccine companies that they bought are developing vaccines for everything from Epstein-Barr, which causes mono, shingles, as well as staph infection. But it's part of a bigger push by Lilly to make sure they're they're really diversified away from diabetes, weight loss. They've obviously made a ton of money in that space, but at some point they're going to lose patent protection on that. And so the hope is that by buying a bunch of early stage companies, at some point, hopefully one of these candidates will become a blockbuster drug 10 years from now when they do lose the revenue from their ultra successful weight loss franchise.
So is Novo Nordisk, for example, doing the same thing, trying to diversify and do deals away from obesity medications?
Novo Nordisk has tried. You'll remember last year they, of course, went after Metsera, but lost in a bidding war to Pfizer. They haven't been nearly as aggressive as Eli Lilly has been. I mean, Eli Lilly this year has announced more than $20 billion of deals. That's more than they've ever done in a single year and more than any of the other pharma companies have done at all. And I think what's interesting about all of this is one of their execs said that from the deals that you do see, you don't even know about the tens of dozens that they're looking at every single week. They say they plan to continue to be active, so I wouldn't be surprised if we're here next week talking about another Eli Lilly deal.
We don't know about the deals, but you know about the deals, Michelle. Always great to have you on. Thank you for bringing us that story. That is Bloomberg's Michelle Davis. Now, another potential big deal overseas. Uber has offered to buy Germany's delivery hero in a deal valuing the company at nearly 10 billion euros. Uber already owns 20% of the company and is seeking a takeover to ramp up competition with rival DoorDash. Natalie Lung, a tech reporter for Bloomberg, joins us now on this. Why delivery hero, Natalie?
If we look at what DoorDash, Uber's biggest rival in the U.S., has been doing overseas, it has bought Deliveroo in the U.K. It has bought Wolt a few years ago, which expanded their presence in Eastern Europe. So Uber is trying to do the same, expand its presence across possibly Asia, Europe, and the Middle East by eyeing Delivery Hero. Some of the challenges there we might expect because Uber's offer is just slightly above the hair of the closing price of Delivery Hero last week. We might see Uber might need to pay up, or there might be rival bids. We already hear DoorDash is also eyeing the Middle East business.
How much have DoorDash and Uber already looked abroad? How important is it for them to expand their business? And could you see like a Just Eat in the UK try to compete? Is it only the American companies that might come in to try to buy Delivery Hero?
We've been seeing a lot of consolidation in Europe. Like these companies have, the market there is a bit fragmented, and we've seen these companies struggle to recover from after the pandemic era. And so these U.S. companies are sort of swooping in and seeing what targets they can pick up.
All right, Natalie, thank you very much. Natalie Long and, of course, Michelle Davis. Thank you both for bringing us those stories. Now, coming up on the show, activist investor Ancora is pushing H.B. Fuller to abandon a proposed takeover. H.B. Fuller now responding. We're going to get the latest with Jim Chadwick, president of Ancora Alternatives. You're watching Bloomberg Deals. It's a sticky situation. Activist investor Ancora is pushing the U.S. adhesives maker H.B. Fuller to abandon a proposed takeover of Advanced Medical Solutions, which is a UK-based company. Ancora says, quote, the prospective acquisition of AMS represents an extremely risky, quasi-transformational international acquisition that is completely out of the management's depth. Yesterday, H.B. Fuller issued a statement in response to Ancora. They said, quote, H.B. Fuller has a demonstrated track record of thoughtful and disciplined M&A. For more on this, we're joined by one of the activists behind the push. It is Ancora Alternatives President Jim Chadwick. Jim, thank you so much for joining. We'll get to the response from H.B. Fuller in just a moment, but first, just the basics. Why do you oppose this takeover of H.B. Fuller to this UK medical company, AMS?
Well, thanks for having me on, Danny. I just, obviously to get to your question here, but just to set the table on that point, I mean, this is our latest, H.B. Fuller's our latest activist position in the industrial sector, where we do a lot of investing. This company, this is an important point in terms of the answer here, but this company is in the specialty chemical space. It's really the only pure play publicly traded adhesives company in the world today. And so, which is a very unique aspect of it, because we think this is a company that has great assets, great market opportunities, has significant interest in the business in terms of potential buyers. And, it being a pure play, being a big part of that, it presents a platform consolidation opportunity for others that are looking to acquire in. And we believe that this company has significant private equity interest today. Despite all these attractive attributes, Obviously, we have real concerns about the competence and the strategic judgment of this board and management team. And really,
just on that, Jim, if I can jump in, because the response from H.B. Fuller has been, we've done M&A, we've done, successful 13 acquisitions, they point out, since 2023, and we know what we're doing. What did you make of their response?
Look, I mean, I kind of expected them to say that. I think there's a couple of points to that M&A question, but the first is that on the point of them doing successful M&A is how do you define success as just kind of as a basic one? Is that's the tenure over Celeste Mastin, the CEO, doing these 13 deals you referenced. They spent approximately $650 million, at least in cash consideration. And over that period of time when they're saying we've had a successful run, the stock's down 25%. So usually when we're looking at companies as an investor and we're measuring success or a successful program or successful capital allocation strategy, usually that's measured by actually shareholders making money. Here it's obviously the opposite. Secondarily, those collective deals, as I said, 13 of them, those would be what we would describe as bolt-ons or tuck-in acquisitions. 650 million is a cumulative number. This deal in particular is over $800 million. So this is more like a transformational M&A deal, which transformational M&A, even with a very skilled management team, is hard to do. So even an A-level management team, it's difficult to pull off a successful outcome. Here, you're dealing with the B or the C team trying to do a transformational cross-border transaction in a business that's not even, along the lines, outside of 25% of AMS is adhesives. The rest of it's in different types of medical products categories where the company has no proven core competencies. And I think our opposition to this is largely based on the fact of some of the issues we raised in our letter yesterday. But the first and foremost is the company just in March had said publicly that their plan was to pause all M&A, closing all M&A deals and focus on deleveraging the balance sheet.
To that point, what has conversation with H.B. Fuller been like? Because you pointed out that they would be an attractive takeover target through something like through a PE fund, for example. Have they been engaging with you on that front at all, or are they just completely opposed to any sort of sale or sale of parts?
I don't think we can answer that yet. I mean, it's the engagement we've had to date with them, which has gone over the last couple of months, has been one about, our strategy here was to keep this private, work collaboratively, try to get a situation where we could roll up our sleeves together and figure out a way to maximize value. This is a company that trades at a pretty significant discount to the value of what the business would get in a sale and where adhesives business transact today. I mean, look at this deal alone. This AMS transaction, which isn't even pure play adhesives, is up north of 11 times EBITDA, and you have a situation where H.B. Fuller trades less than 8 times. And so, anytime you see a company levering up and then looking to buy up their multiple, usually that doesn't work in terms of multiple expansion. If anything, it could go the other way. And now they're taking leverage up over 4 times. So, look, we've been engaging with them about that. We wanted to engage in ways and the best way to maximize value for all shareholders. And, ultimately, this would be about running some type of comprehensive strategic review, which could ultimately lead to the outright sale, maybe parts of the business, or it could really run the spectrum as far as that analysis goes. And our goal usually in these situations is let's get people in the room to roll up their sleeves together and try to figure out what's the best way to maximize value, because we know that the plan has existed with Celeste to date has not generated any real economic value to shareholders.
Jim, if we can zoom out, because you've done a few successful activism campaigns, Warner Brothers, Americold, now of course this one with H.B. Fuller. One of the other areas that I know that you're interested in is the impact that AI is having on M&A, and you see opportunities specifically there. What are you looking at that's changed in this environment as technology rapidly shifts for corporate America?
I think it's really more of a function of when you describe activism or M&A activism, which is something we've done a lot of. We did it, obviously with U.S. Steel last year. We've been on both sides of these situations. Some where we're coming in trying to either push for a transaction, or some where we're trying to defend against, a transaction happening. And in the case of Ritchie Brothers, we're actually defending the merger with IAA. So, but M&A in general creates a lot of opportunities for activists as a whole, whether it's kind of pushing the company to the finish line or playing a role helping the company get there. But AI in particular, I think, is a very unique role in that it's going to create, and it is creating significant displacement in the market. We see it already with what's happened with the SaaS software companies. And, we don't do a lot in software, but that actually does create opportunity. Obviously, these types of situations where these AI companies are showing a willingness to vertically integrate, which whether they're investing in new power sources, data centers, hardware and user applications, some of these companies are going to need a nudge. Obviously, I think, to kind of get to the right place, which is participating in this. And I think activists will play a role in that, trying to get them there.
But Jim, sorry, we're just out of time, but I did just want to say that hopefully when you give these companies a nudge, you let us know and you come on and you join to talk about it. We really appreciate it. I wish we had more time. We could talk about this for a while, so please come join us again. That's, of course, Ancora Alternatives President Jim Chadwick in his latest campaign. Now, coming up on the show, PGIM is digging into asset-based lending via the housing industry. We're going to take a closer look in our alternative view right here on Bloomberg Deals. Time now for an alternative view. PGIM announcing this week its partnership with Domain Real Estate Partners has raised about $4 billion for 7 residential land banking projects. Scott Carpenter, Bloomberg's credit reporter, joins us now. First, the obvious question, what in the world is land banking, Scott?
Land banking is when a home builder will temporarily sell an undeveloped plot of land to a land bank, which holds onto it while you do the logistical stuff, and then when the home builder is ready to build houses, they buy it back. So this is a way that they don't have to hold undeveloped land on their balance sheet. They say it's a way for them to be more efficient.
So why is it getting bigger, and why PGIM?
Well, PGIM, first of all, is not a land bank. What they are doing is helping the land bank, Domain, do these deals. Why is it getting bigger? PGIM is interested in this kind of thing because it's part of asset-based finance, which is the idea of financing specific assets rather than entire companies. And that is a major trend that's been going on.
Yeah, it definitely has been. Scott, thank you for bringing us this story. Really appreciate it. That is Bloomberg's Scott Carpenter. Next up, it's our IC, and we're going to discuss real estate further. This is Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's go straight to Nora Melinda, who's taking a closer look at real estate deals. Nora.
Well, capital is flowing back into real estate, and in a very big way. And right now, to no surprise, AI infrastructure is one of the biggest drivers behind it. AI-related capex from the largest hyperscalers could approach $5 trillion over the next 5 years. That's according to a Bloomberg Intelligence estimate. Amazon and Alphabet are each expected to spend more than $200 billion over the next 12 months, with Microsoft at $170 billion. Now, a huge chunk of that is going straight into data centers, power infrastructure, and industrial real estate. Deal activity is picking up globally, with major players leaning in across regions. Blackstone launched a $1.75 billion data center REIT. Oracle's ramping up AI data center construction tied to OpenAI and xAI. And CoreWeave is backing new capacity deals as appetite stretches from Asia to Europe and to North America. Meanwhile, housing is also seeing fresh momentum. You just heard about PGIM's $4 billion home builder deal. Avalon Bay Communities and Equity Residential also recently announced what could become the biggest REIT merger ever. And in private markets, investors say they're still leaning most heavily into industrial and logistics properties, followed by data centers and multifamily housing. That's according to a Bloomberg Intelligence survey.
Nora, thank you so much for that wrap up. And with capital flowing into everything from AI infrastructure to multifamily housing, the question is, where do investors now see value, and what parts of the market maybe are getting overheated? And that brings us to this week's investment committee. So pleased to say that on the committee this week is Bess Freedman, CEO of Brown Harris Stevens, Annette Kroeger, CEO of Europe, Pimco Real Estate, and Liz Hart, President of Leasing for North America at Newmark. I love this IC today because you all cover different areas, from more commercial to residential to Annette, of course, covering Europe. Liz, let me start with you in some of the areas that Nora was talking about what AI is doing to this market. I know in particular you're seeing like this frenzy in Manhattan and San Francisco. Just how have volume levels exploded?
Well, it's definitely exploded this calendar year. New York saw more AI leasing in the first quarter than it did in the entirety of last year. San Francisco recording record tenant demand again. And what's interesting is 76% of the tenants we're tracking across all categories are looking for the same or more space right now. So pretty healthy demand.
So is this like the hottest part of your market right now, would you say?
I would say AI and also trophy. The trophy segment is incredibly performing as it has been for a while. We don't see that changing, especially in the gateway cities where the trophy's really pulling ahead from a spread perspective.
I'm guessing for you, Bess, like high quality residential is still king. I wonder if you're seeing any AI related trades too, or more residential properties popping up around some of these AI hotbeds, or where maybe AI data centers are being constructed.
Well, I think that the real estate, the residential is always hot and desirable, and the rental market, as you were talking about with AI, is there's such a emergence of people finding information with AI in rental communities. But the residential real estate market has been really performing well considering all the chaos in the environment.
I was going to say, because there has been a lot said about K-shape, about people worried about losing their jobs at AI. Maybe that's the other side to this trade. Is there any sort of anxiety that's holding buyers back?
I haven't seen that. More of what's holding buyers back, I think, has been the political landscape. That's put pressure, the new taxes that are being discussed. I think the affordability issue is one. I think the higher mortgage rates. I think the lack of inventory. Those are putting more pressure on the residential market than things related to AI.
So I want to get to all those in a moment. Okay. But first, and Annette, let me bring you into the conversation. You're seeing these mega trends in the U.S. around AI data centers, around AI jobs in particular. How present is that in Europe? And if so, where are the opportunities there?
I would say it's very much present in Europe as well, even though, as we know, it is a more stable environment here in Europe, generally speaking. I would say, of course, we're seeing the dynamics of it, right? Clear winners of AI, digital infrastructure. You talked about data centers already. Clearly a big bet that people are making in Europe as well, where the markets are probably a little bit behind the US. We have lower supply levels in data center space compared to the US, so some catch up to do, and therefore probably an even more outsized opportunity there that we strongly believe in. At the same time, I think AI also creates divergence and stronger obsolescence. So it is something to think about in your investment strategies. Looking at office, we probably expect a bifurcation of the bifurcation. Even more high amenitized, high quality space that will be in demand, but even more difficult for secondary space. And it's also about which cities to invest in, right? AI will probably generate higher capital returns versus labor returns. And as such, going to capital-rich cities is probably a good strategy in the AI context.
There's certainly a lot of question marks and kind of on the same note of Bess as legislation around some of these investments. And Annette, especially for Europe, when you're dealing with maybe more of a fragmented market, how are you thinking about AI investments in data centers when there has been growing political pushback?
We continue to believe in the opportunity when it comes to data centers. I think we're very much focused on tier 2, tier 3 cities, because what we see is, you mentioned the fragmented markets in Europe. Data sovereignty is a big topic. So we always want to be in data centers that are in specific countries close to the consumers, where you have, the availability of fiber, of power, which are important factors to look at. AI definitely drives demand beyond that. Training AI, for example, which you may want to do in more remote locations, but we have stronger convictions where you're close to the final customers as a longer term play.
Are those trends very similar in the U.S. too, Liz?
I think they are very similar, yeah. I mean, power is really driving the show as it relates to demand, and we know that. But it's power and then it's people, and that's what you were talking about too. It's talent. Talent is a huge driver of the office market and of the industrial market as well. And I think as you look at the talent trends, that's really where the opportunities for investment are.
Yeah, because the AI can certainly empower real estate agents, professionals, to give them information, get it to the consumer quicker. But for example, for us, when you're selling a home, it's sacred. They want to talk to a person. You're opening drawers, you're in their closets, you meet their kids, their dogs, all that stuff. So AI is not going to replace that, but it can certainly empower the process.
Well, and just to also get back to that other point about tax regimes and how that's impacting things. DeSantis today finally put out his proposal to scrap a large chunk of some of the property taxes happening in Florida. Is that migration just going to pick up steam of some higher tax regimes into lower tax regimes for residential?
I think we've already seen a lot of that. We've seen an out-migration of New York to places like Florida because of our tax policy. And now there's going to be this pied-à-terre tax that's going to probably get enacted in July. And I think that's going to change purchasers' behavior. They're not going to buy second homes here. I think it will have a very negative impact on the market in New York City. And we'll see more people deciding to invest in Florida versus New York, which I don't think is a great idea.
Is that, I mean, then does the Florida property market, how hot does it look then? Do valuations look frothy, kind of artificially so because of what's happening?
Well, they've already been frothy. I mean, look at Palm Beach. I mean, you can't keep anything on the market there. It sells right away. Everybody's going there. The demand is so high, and there's not enough supply. So it has already been a little bit frothy. Will it get frothier? Probably.
What about the political pushback, as I mentioned to Annette, that's happening in the U.S. around data centers? I'm from Northern Virginia, and there's a lot of drama there about locals saying we don't want data centers around here. When it comes to the AI infrastructure, how much are you having to think of more local legislation?
I think that's certainly a factor, but one thing that we're seeing more and more of is the advanced manufacturing jobs that are going proximate to those data centers. So when can you bring jobs proximate to those other activities that are needed to fuel the economy? And that's where we're seeing the real opportunity.
So I think it's worthwhile, just while we have you three here, taking a step back just on this rate environment and what that's doing. And Annette, let me start with you, because in Europe, you're facing more of an acute issue when it comes to energy. You've had central banks, the ECB, more front forward, saying maybe the next move might be a hike instead of a cut. How is that impacting your investment thesis at this moment?
Yeah, I think it's a bit of a continuation of what we've been seeing in the context that it's an uncertain and a volatile environment, right? It's hard to predict what rates will be doing. And as such, the focus needs to be very much on resilience and on income. So it's back to the basics in real estate. We're looking at assets that offer long-term, stable, inflation-hedged income. And then you're looking about how to drive NOI at the asset level and be very operational, deliver operational excellence to drive that NOI. You can't do a broad-based sector bet anymore like you could. Like logistics, for example, was a bet that many people made because you had a lot of cap rate compression. Unlikely in this environment. So it's about creating that resilience at the asset level and be very selective where you invest and where you see that income.
Liz, I see you shaking your head, kind of similar outlook for you?
Yeah, absolutely. It goes back to the asset level. What is the asset? What are its fundamentals? What CapEx can you put into that asset to position it better? And where's the tenant demand? And where's the tenant demand going to be durable beyond this cycle that we're in?
And I guess for residential, it's been the issue you've been pointing out.
We've been talking about the rates.
Yes, exactly.
I mean,
and the lack
historically,
of supply.
though, Danny, they're still low, but they just are not going to change or go down to like 3% or 4%. It's just not going to happen. There's no catalyst for that, and we're not going to get a cut from the Fed. So I think buyers need to accept the fact that this is where rates are, 6%, a little bit above. I don't think that's changing anytime soon. It could even go up.
Does supply change anytime soon if the rate side of things aren't going to?
I mean, that's been the push and pull. We can't get supply and demand to like come together. As I always say, like it's like the boys and girls at the dance. We got to get in the dance floor and get things done. And so I think we need to have more incentives based on getting more supply, like upzoning. We need to do more city of yes. And less rent freezing and more city of yes. That's my opinion.
All right, we're going to have to leave it there. Thank you so much for joining. Really appreciate all of your time. Thank you to today's investment committee. That's Bess Freedman, CEO of Brown Harris Stevens, Annette Kroeger, CEO Europe of Pimco Real Estate, and Liz Hart with Newmark. Coming up on the show, tech investor and entrepreneur Anjney Midha joins us next to discuss what he calls the compute bottleneck with hyperscalers and how his firm is trying to address it. That's coming up next. This is Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. AI investment is surging to new heights, with the top 4 hyperscalers expecting to spend more than $800 billion over the next 12 months. AI infrastructure and venture capital firm AMP has raised more than $1.3 billion with the aim of creating something that pools capital, buys compute, and provides it at cost to startups. Its founder, Anjney Midha, most recently was general partner at Andreessen Horowitz, where he was one of the first investors in Anthropic. And Anj joins us now. Take a look at the big picture. Wonderful to have you. And look, this is a market when it comes to compute as something you've described as a market structure that's broken. Anj, exactly what is broken, and what is AMP trying to do about it?
Yeah, great to be here. Thank you for having me, Danny. What's broken is what was broken, the same thing that was broken 100 years ago when electricity showed up. Right? Electricity was a general purpose technology, and it changed everything. And when it became clear and legible to the world that you could use electricity to make useful products like steam engines and cars, people started hoarding. And the reason they started hoarding that electricity is because it was so valuable to have access to that input at a time when it wasn't clear to people how it would be used, when it would be required, because at the time, people were doing a lot of research with electricity. There was Bell Labs. Edison was working on figuring out how to electrify the world. And so when you have a scarce input, like electricity or coal, and the output is really valuable, people who have the largest balance sheets start hoarding it. What that resulted is about like 30 to 40 years of just absolute chaos and pain in both America and other Western nations, until there was a breakthrough in standardization. What it required was two solutions, two important sort of alignment mechanisms to make sure that that electricity was distributed in an even and accessible way to the people who needed it the most, and then that there was coordination to enforce the standards. The first was the standardization of electricity on AC/DC. Right? Until then, it was really hard to actually convert those two. So megawatts were not always just megawatts.
Right.
And then the second was a coordination mechanism called the grid. And so what we figured out as a society is that when you have a scarce resource, what you need to do is to share. You need to pool capacity and needs across everybody. And to do that, you want to standardize that resource and then enforce through mechanisms like utility companies and grids, the ability for different types of customers like residential homes and factories and universities to all have the peace of mind that their base load is taken care of, but that they can spike up and down.
I see where you're going with this, to create this again in AI data centers and compute, but how do you compete with these big hyperscalers that can throw so much money behind hoarding all of the power and all of the AI compute?
Yeah, that's a great question. So back to the future, we have created a grid. My engineering co-founder created this grid at Google at scale. It's called the Borg Export GQM scheduler. I won't bore you with the details. But not only have we created a grid that pools capacity across a bunch of different clouds and providers, as well as AI labs, today I'm really excited to announce that we're announcing and unveiling a $100 billion frontier grid security program. Over the next 5 years, we plan to raise $100 billion for grid security in America and our allied nations. We've raised a meaningful amount of that already. And we've also announced that we've deployed a meaningful amount of that in role models who are helping land, energy, power, all parts of the supply chain in America, all the way to the model layer and beyond, to unveil what the good examples are for good behavior. One of them is Anthropic. We have deployed a meaningful amount in Anthropic this year, and we expect to do more. We're inviting partners. Of that $100 billion, 20% is committed from our own capital, and the remaining we're inviting partners to. In the last 2 weeks, we've received over $6 billion of interest. And so, how do you make a dent in the universe? Well, you build products and solutions, and then you get people around the table and say, this is one of the most valuable infrastructure investment opportunities of all time. By your own admission, about $5 to $7 trillion worth of AI infrastructure spend is expected over the next 5 years, and we think you should take 2% of that and put that in grid security.
Yeah,
we think it's a pretty fair trade.
And thank you for bringing us that announcement. That's super interesting. And I mean, it's a market is kind of you're describing as one that's, and many people have, is chronically undersupplied. What then do you look at for potential signs of overbuilding? Are we anywhere near that? Is there any froth, you think, in the system?
I wish. Look, because we are in the pre-standardization era of compute, what's happening is the spread between base rates and on-demand rates right now, from the data we're looking at, is roughly 2 to 5x. So for example, if you look at a chip like an H100, which is a 3-year-old chip, if you can even find it on any of the hyperscaler marketplaces, which honestly you can't for this year, the on-demand rates are 5x. For GB300s, it's somewhere between 2.5 and 3x. And I think this is going to get worse. My hope is that by standardizing compute, we can have flops flow like megawatts. But for this year, from the data I'm seeing, it's not looking good. Not for the independent teams who are not inside of hyperscalers.
Hey, before we let you go, I have to ask about your course at Stanford, which has been dubbed AI Coachella, which is awesome. And please let me just sit in the back at some point. And I want to ask you, because there was recently an op-ed from a Stanford senior basically describing almost an apocalyptic attitude among the students there that like all the generational wealth has been had, that if you haven't already been early at Anthropic, which we should say you were one of the founding investors at, that you're kind of done for, and you should have already left Stanford and graduated and founded your own AI startup. I wonder if you get a sense from some of your students, from this idea that perhaps everybody is already far behind an AI race and the winners have already been made.
Oh, these kids. Look, I find the Gen Alphas or whatever they are, they're just anxious, and we need to remember that as stewards, as adults, as role models, we got to remind them that they're like sitting on the cusp of history. It's the best time to be alive and be graduating. The senior project for this class is this one-person frontier lab, and what we tell them is, with the right tools, you can scale yourself endlessly, and I genuinely mean that. In fact, I expect to invest millions of dollars into alums from this class. A former TA. We've taught this class for 4 years in a row. This year just happened to be really popular. It's 500 students. It's the largest CS class on campus, as far as I'm aware. But I think we have to remind these kids that there's opportunities there as long as they put in the work. You can't outsource your thinking to AI. You can outsource your thinking to AI, but you can't outsource your understanding. And when I spend time with the students, their brains are so incredible because they've grown up on so much information. And the ones who actually are able to sit down and channel their focus are able to understand a topic, whether it's energy, uranium enrichment, or machine learning. I mean, this generation is the opportunities available to them. As long as they're willing to not outsource their understanding and put in the work to create new kinds of products and services, I think it's going to be a generational cohort. I mean, I've never seen anything like it.
Your class has got to be the most popular, right? It's got to be the most popular at Stanford.
It's not a popularity contest. I'm very grateful to Stanford for letting me continue being
a
lecturer.
If it was, I have a feeling you might be winning. You're going to have to end things there. Thank you so much for joining us. That's, of course, Anjney Midha, the founder of AMP.